Good evening, everybody, and thank you for joining us on this edition of the Monthly Market Insight. As always, it's a delight to have these sessions and to see the kind of responses and mails that come in from all of you, because that gives us a context with which we can approach the session and try to make it as useful as possible to each and every one of the audience who have logged in for this conversation. And of course, this will be hosted on our YouTube channel later, so you always have the option of listening into it later if you so wish to. Today's session, as usual, I will be joined by my colleague. This time it will be Sachin Trivedi, who is the fund manager of the UTI Transportation and Logistics Fund. He is also our head of research and therefore has a wealth of experience and knowledge covering multiple sectors within the market space. And today we'll have another colleague from the product team, which is Sonal Mittal, who will be handling the presentation and sort of organizing the flow of the entire presentation. So without any further ado, we'll get going today. And I'll request my colleague Sonal to bring up the presentation on the screen. So you should have that coming up in front of you now. So the way we'll do this is similar to every other time, but with a slight variation, based on some of the queries that we had seen coming in. It was very evident to me that there were quite a few questions once again coming, which were more economy related. I think particularly relating to the US economy, the risk of a recession, what is the likelihood, how much can rates go up, and also coming down to India, of course, in terms of economy, where of course we had the MPC's own statements and forecasts come out last week. But equally importantly, there were some concerns raised about the size of the trade deficit and the risks to the currency on account of the current account deficit. So the way we are going to do it today is first we'll cover some of these economic agenda points. And then we'll move on to the standard section on equity markets and valuations. I'll actually spend less time on that today. And then I'll hand over to Sachin, who will take the investment strategy on UTI TNL fund, and then few common questions that have come into us for today's session. So moving ahead to the key economic charts. Right. So this is the first chart. And as you're well aware, the Fed has already hiked rates by 225 basis points in calendar 22. Now, this is quite unusual because if you remember and you go back in time to September, October 22, this was a point in time where the narrative was still about inflation being transient. And in fact, the markets were not expecting rates to move up till 2023, whereas inflation has surprised on the upside. The Federal Reserve has hiked rates by almost 225 basis points. What has the RBI done? Now, the RBI has actually sort of moved its benchmark rate, in a sense, from the reverse repo to the repo rate. So what is plotted over here in that thin blue line is the reverse repo rate, and you can see it's gone up. But because they have actually pivoted from reverse repo to repo, we would argue that the actual increase in terms of the rates is closer to the tune of 200 basis points plus over the course of the last few months, even though the actual hike in the repo rates is only 145 basis points, plus you add 65 basis points for the pivot. And in effect, it means that RBI has hiked rates by almost 200 basis points plus. And therefore, in a sense, both the Fed and the RBI so far have more or less been in lockstep through the course of this year. Now, what does this mean and what kind of an economic environment are we seeing in the US? You can see this on the next slide. And this slide will also provide you some context. What we are tracking over here is US manufacturing new orders and how these orders have behaved during every period of Fed tightening. So this data goes back about 12 years, and you can see here that typically the Fed starts to tighten, new manufacturing orders start to go down, and typically when the new orders drop below 50 is the point in time where the Fed actually backs off from its hawkishness. Right now, however, we are in an unusual situation which is that new manufacturing orders are now below 50, which means it is in contraction territory, but the Fed remains in a sense sort of hawkish. And we've seen in the last few days commentary coming from several Federal Reserve governors in the US indicating that they expect that perhaps it calls for another 75 basis point hike at the next meeting. So this is unusual, whereby into a contraction the Fed remains hawkish. If you move on to the next slide. Now, in the US, there is a data for everything. You can pretty much get a data point for everything. And this is a probability of a recession over the next 12 months. You can see over there the spike which happened in the probability of recession due to COVID. And now, once again, there is a sharp upward movement in that line. It's just crossed the 40% mark. So there is now, the markets are pricing in a 40% probability of a recession over the next 12 months. Now, remember, the US has already seen 2 quarters of negative GDP growth, which, if you remember our economic textbooks, would constitute a recession. But in the US, they have a system whereby there is an independent body, the NBER, which looks at a variety of data, not just the GDP data, and then decides whether there was in fact a recession, and then they put the date of the start and the end of the recession. But that body can take 6 to 12 months after a recession has started and ended to actually deliver its diagnosis that a recession indeed has taken place. So they have not yet given any prognosis at this point of time. So you do have 2 quarters of negative GDP, but the markets are still forecasting a possibility of recession over the next 12 months, which means the market is still expecting the probability of US economy in negative territory somewhere down the road. Now, if you move to the next slide, this is very interesting because remember, the Fed made this pivot in terms of saying inflation is no longer transient somewhere in October, November 21. And then you can look at that 10-year bond yield from below 1.5%, it starts to spike into Fed tightening. It goes all the way up to almost 3.5%. And then at the weakest point in July, it actually dropped almost 80 basis points from the peak to somewhere, closer to 2.5%. It's gone up again in recent few days. But what does this mean? This sort of downturn in the 10-year GSEC yield in the face of expectation that the Fed will continue to hike is in fact starting to, as we have discussed in a previous monthly insight, it has inverted the yield curve, which is actually seen as another lead indicator of the potential for a recession in the US. And therefore, because of that risk of a recession, the long-term yield has actually started to come down, whereas because the Fed will continue to raise the short-term rates, you actually get an inversion of the yield curve. Something similar has happened in India as well, where yields have sort of cooled off marginally from the recent peak that we've seen, but nothing as dramatic as the US. And that's also for the reason that nobody really expects to see a recession in India, given that our growth trajectory is vastly different. If we move on to the next slide. Right. So in the Indian context, I think one of the questions that we received was to do with the trade deficit, which is on the left-hand side. You can see how that trade balance during the COVID time, the trade balance was very small. We should ignore that. Look at the period in 2018-19. At that time, the sort of cyclical peaks in the trade deficit were about $20 billion. But last month, we printed a trade deficit of almost 31, which is a record trade deficit. And this has obviously caused some bit of concern and anguish, and also worries about, do we have enough defenses against this fall in the reserves? Simple answer is yes. One, the reserve for June is overstated. It's overstated to the extent that it reflects the worst possible fuel prices. And as we know, all commodity prices have corrected, including oil prices. So we do think with some kind of a lag, this will show up in the trade balance numbers. Also, very important to remember that as much as we may have concerns on the trade balance, look at the slide on the right-hand side, which is RBI's total reserves. They're still just slightly below $600 billion, around $570 billion. So still very, very comfortable. And relative to our imports, which is that dark blue line that you see on the right side, we are still about 9+ months of cover in terms of reserves. So I would say, yes, the trade balance is uncomfortable as reported in June, but looking at our FX reserves, the cover is significant. Looking at the foreign exchange borrowing that India has, which is not on this chart, but it's a very limited number, just about 20% of GDP. I would say we have a fair bit of comfort that, yes, trade balance is uncomfortably high. This will put some pressure on the current account balance. We will see reserves drop over the course of this year, but still, we are reasonably well protected because the initial condition, which is the level of reserves, gives us some comfort to absorb these negative pulls. So that's sort of some of the key economic slides that we wanted to share with you today. So what I'll do now is run through the equity markets and valuation section, but I won't run through each and every slide. Very quickly, we'll just jump straight to the earnings picture. So if you just move 2 slides down, and remember this slide gets shared, so you can always take a look at this detailed presentation later on our website. But here we are on the earnings trajectory for the Nifty 50. And as you can see on the right hand side, the earnings forecast for March 23 is now a 11% increase in earnings. Now, interesting question, have there been cuts to FY23 earnings forecast? Short answer, yes. And you can see that on the next slide, where you will see that line, the dark blue line. When you look at the right hand side, the second line from the top, you can see that the dark blue line has showed a gradual descent over the last few months. And this is reflective in some of the cuts which have happened to consensus EPS, which is a function of the margin pressures that we have seen in corporate India, particularly because post-Ukraine, there was this massive flare-up in commodity prices, and companies cannot pass these increases in commodity prices to their customers overnight. So some of those earnings have been cut as companies have reported earnings for this quarter, and that's what is showing up in about a 3% decline over the last 60 days in the forward earnings forecast for March 23. There is still some risk, I would argue, to overall earnings forecast, but these are now driven more by global growth, and we'll talk about that later. So if we move on now to the valuation slides, which will come up next. So first we have the slide for the Nifty 50. On the left-hand side is the trailing PE multiple, and on the right-hand side is the forward PE multiple. Now, the area between the green line and the red line is what we call fairly valued. So on the trailing PE basis, the market is still within the fair value zone. But on the right-hand side, when you look at the forward valuations, the market had come into the fair value zone. It's slightly edged above that red line. So just I would say it's at that edge of fairly valued and expensive based on forward valuation. But on trailing, it's just slightly above the long-term average and slightly more comforting. If you move to the next slide, this shows you the price to book multiple. Here we are still within the green line and the red line, but above the average line, which is in yellow. And that still gives us, sorry, if you just go back to the previous slide. Yeah, so this is the Nifty 50. It's between that yellow line and red line, which tells you that it is still in the fair value zone. And it's not a bad thing, because when you look at the right side of this chart, you can see the Nifty 50 return on equity. This is actually the highest return on equity for the Nifty 50 in almost about 8 years. So, in a sense, the fact that the price to book is slightly above average is not surprising given the current ROE outcomes that we are experiencing. This is for the large caps because that's what the Nifty 50 represents. What about mid caps and small caps? We can see that when we move to the next slide. On the left-hand side is the trailing price to book of the mid caps, and then on the right side is the trailing price to book of the small caps. I would say that the mid caps, again, at the edge of fairly valued and expensive. So, maybe one can afford to be bottom up over there. It's sort of borderline fair value. It's the small caps which still look slightly expensive. These are actually still trading slightly above the fair value zone. So, from a valuation point of view, we think large caps in general in the comfort zone, Nifty mid caps sort of at the borderline between fair value and expensive. Small caps on a relative basis, when we look at large caps, looking slightly unattractive on an absolute basis. If we move on to the next slide, right. So this is a comparison of the 10-year bond vis-a-vis the earnings yield of the Nifty. This is still sort of favorable in favor of fixed income, not really moving in favor of equities. That yield needs to come down to 1.03% to be in favor of equities, whereas right now it is still more in favor of fixed income. And of course, there was a point in time a month ago where this was looking slightly better, but we've had a massive rally in equity markets through the month of July, and therefore to that extent, this is not looking particularly attractive vis-a-vis bonds at this point of time. I'll jump the next slide because I think we've already talked about the relative preference. Nifty, large caps most preferred, mid caps, and then small caps. So let's come straight here, which is the summary. So there are still significant fears about US growth. Because the Fed is having to hike rates, because inflation is well outside their comfort zone. Remember, the US Federal Reserve's comfort for inflation is about 2%. Of course, many years they had inflation below 2%, so they indicated that for some time they wouldn't mind inflation being about 2%, but it's been well above 2% for very long now. And, we could presume that their comfort zone would still be only 2.5%. So they are still under tremendous pressure to hike rates. And, that would eventually cause concerns about growth, and which is why you are seeing, that 10-year bond yield actually sell off in the face of, rising short-term yields. What's the status of the rest of the world? Europe actually has the worst of both worlds today. They have significant growth risks. Inflation poses a very big challenge to them. And they have an energy crisis because they were very dependent on energy supplies from Russia, and they have both a volume and a pricing problem. China's growth is being impacted by the zero COVID approach, and you have seen this in a lot of the Chinese data, which is now tending to disappoint. So, in a sense, the global setup is not very conducive. You've got low growth outcomes in Europe, you've got a growth problem in China, and you've got concerns about US growth going forward. And in a way, commodity prices are reflecting these growth concerns. They have dropped very sharply. In fact, I would say the majority of the gains in commodity prices post-Ukraine have now been given back, and many commodities are trading at the prices that they were in December, January of this year. Oil still slightly above the start of the year, but again, well off the significant highs that we saw in April, May. In India, remember, inflation target zone is 4% plus or minus 2%, and it's running at 7%, so it's outside the upper bound, and therefore India as well will likely to see some rate hikes. But the gap between the comfort zone of the MPC and Indian inflation is much smaller than what it is in the US. So while we do expect further rate hikes, it's unlikely to match the trajectory of what the US Federal Reserve might have to do. Our macroeconomic indicators, more or less comfortable. There are some pressures. The recent surge in CAD, as I said, is likely to normalize. The trade deficit is likely to normalize. And the fact that we have high forex reserves and we have low foreign exchange debt give you some mitigants. High frequency data in India is continuing to trend well. And one of the, I would say, changed data points that we got recently from RBI is capacity utilization. When the governor spoke last week, he indicated that now capacity utilization as per RBI, as they track it, is now running well above the long period average. And that's a positive because that's the kind of level at which corporates would be incentivized to embark on some level of capex, though there could be other mitigating factors and concerns which might hold them back. But at least this data point for the first time has moved into the zone where companies are likely to consider increases in capacity. Earnings estimates in sectors where both volume and pricing are sensitive to global growth trends could see challenges. So, things which are exposed to global trends, either in terms of volumes or pricing, both could see challenges. Domestic, slightly better protected, but again, there will be knock-on effects from one sector to the other. Large cap valuations have climbed in July, but as I said, they are still broadly within the comfort zone. So that's sort of a summary of everything that we wanted to put on the table today in terms of providing you with some of the questions that you all have come up with on the economy. Where are we in terms of valuations at this point of time? I will halt right now my section of this presentation and hand over to my colleague Sachin. And Sachin will take up the discussion on the UTI Transportation and Logistics Fund, which is a unique fund. And, we're very happy to see that year to date, it's been something which has done very well, benefiting from, the combination of both bad news as well as attractive valuations going back almost a year. So over to Sachin.
Sorry, can we move the slides on this? Sorry, I was on a mute. So, but yeah, thank you, Vetri. Thank you for giving me this, and thank you everyone for joining this call. So today we're going to talk about UTI Transportation and Logistics Fund, and as Vetri said, it's a unique offering from UTI, which primarily invest in auto and auto ancillary stocks and logistics space. So our exposure to auto and auto ancillary is close to 83%, but the exposure is between, in general, if you have observed the portfolio for us, is between 80 to 90% is what we invest in auto and auto ancillary, and between 10 to 20% is allocated towards logistics. So obviously, the space has a longer term story, as well as there has been a pain in the space in last couple of years, which is what we are going to discuss, which is where there is a short term opportunity in the space as well. So Sonal, can we move to the next? Yeah. So from the longer term perspective, we all must be wondering Indian market. But when we look at this chart is clearly indicating to us that from the volume perspective, Indian market is one of the largest, or maybe in the top five market from the volume perspective. But when we look at from the penetration per 1,000 people, we actually figure in the bottom, at least among the prominent countries, our penetration is substantially lower. Just to give you a number, it is less than 3% in passenger vehicle. That's the kind of penetration that we have. But the bigger story is not just the volume, which is where we find that we are big, but a substantial good amount of potential. There is even larger potential in the market, because just to give you some figures, in terms of average selling price globally is higher than 22-23 lakh rupees, whereas in India this number is slightly less than 8 lakh rupees. And now, although this number has been inching up, but it is substantially lower than the global averages. Even now, we've just pointed out China here, but we, in terms of penetration, we are significantly lower than some of the emerging markets as well, which is where there is a long-term potential in the country for the sector, and there is not just the volume opportunity, there is the higher selling price opportunity as well. Now, coming to the short-term pressures that we have seen, so this was about the longer term, and we're going to talk about it. But where the opportunity is, if you now this is slightly busy slide, but here we have put out longer-term volume growth for 4 sub-segments in the sector, which is the passenger vehicle, two-wheeler, MNHCV, and tractor. Now, if you observe that what has happened in 2020, which is before COVID, right? Across the segments, whether it is passenger vehicle or two-wheeler or MNHCV, or specifically these 3 sectors, you've seen large decrease in volume. This is such large decreases in volume have not been observed for last 2 to 3 decades. right? So post that decline, there has been some recovery, except in case of two-wheeler, which continues to face the challenge in terms of volume. Now, but in M&HCV and passenger vehicle, there has been a recovery. Now, optically, this looks a recovery, but if I were to talk you from the numbers perspective, passenger vehicle from its peak in 2019 is still down by 10%. Two-wheeler is down by close to 36 odd percent, and M&HCV is down by still. So optically, FY22 looks a fantastic growth, but it is still down by more than 38 odd percent. So that's the story. This sector is a growth sector. It has good potential to grow, but despite that, there has been a volume decline in the sector. Now, obviously, the question from our side is that why is so? There are a couple of reasons behind this challenge for the sector. But if I were to put it simply, the cost increase has been significant compared to the income, right? So we've seen that in last, especially post-COVID, and even prior to COVID, we've observed that the income growth has slowed down as far as economy is concerned. And maybe this is a sequence of event, which is there was a demonetization, then there were a couple of regulatory changes with respect to GST, then there was some financial, the NBFC crisis which hit. So there was some bit of slowdown, and then we have seen the COVID-related slowdown, which has happened, and that has really pushed the ability or the income of people down. But at the same time, starting 2017, there were a couple of regulatory changes which have taken place. These regulatory changes, as we've all observed, that we moved from BS3 to BS4, and post we have skipped one whole generation of regulation and straight away moved to BS6. Generally, one generation to second generation, it takes 6 to 7 months. That's the global standard. But this time, within a matter of 3 to 4 years, we have actually skipped to, we have moved from BS3 to BS6. That's resulted in significant cost increases. And at the same time, government has also introduced multiple safety regulations. So now 2 airbags are compulsory in two-wheeler. I don't know if you've observed, but let's say if you're driving 125cc and above motorcycle, there is ABS channel, which is for the driver's safety, but this is an added cost from the buyer's perspective. At the same time, even in the lower end, there has been a CBS channel. So there are multiple regulatory changes which has happened. This has resulted in significant cost increase, and on top of that, what we've seen is that there was a significant commodity inflation. So many of us would have invested in metal funds or metal related stocks, and maybe we've enjoyed the rally there, but as a consumer, somebody has to pay for it, which is where there has been a cost inflation. This has resulted in significant volume pressure as far as the entire sector is concerned. So can we move to the next? So what's the resultant impact on the companies, and which is where I'm excited from the investor's perspective, is that this sector, which is, let's say, from 2014 to 2019, has given at operating level 18% CAGR as far as EBITDA growth is concerned. But because of the significant volume challenge that we have seen in the sector, be it because of the significant increase in the cost and therefore decline in volume, at the same time, there has been significant increase in the commodity cost. It has actually compressed the gross profit margin of the company. It has compressed, the lower volume has resulted in significant operating deleverages, and therefore you see close to 11% decline in EBITDA. This is in CAGR terms. So there has been significant profit pressure on the companies which are operating in this area. And today, when we are investing in this sector, we are investing at this compressed levels, which is where there is an opportunity as far as sector is concerned. Because remember, if you are selling at at the right level, you don't have to offer any discounts. But if you are selling lower, maybe 38, 39% lower than your potential capacity, to sell the same stock, you have to offer higher discounts. So all these multiple factors, cost pressures, operating deleverage, higher discounts, everything has resulted in significant decline in the operating profitability in the sector, which is where our expectation is that now post-COVID, the life getting normalized. When you normalize, there is a potential demand as well, which is the replacement demand. We will see a reversal happening towards mean or even better, and that is where the opportunity from the investor's perspective is. And this is again trying to capture the longer term potential. So essentially, between 2005 to 2014, the average GDP growth was, let's say, around 13% in nominal term. This sector has grown somewhere around 11 odd percent. This is just in volume terms. On top of that, there is 3.5% ASP growth. Remember, I have spoke about less than 8 lakh rupees kind of an average selling price in the sector. This used to be less than 5 lakh rupees couple of years back, because in olden days, Maruti Alto, which was the favorite vehicle for most of us to get into, or that was the highest selling model in the country, the cost itself has gone up. So average selling price is no longer 2 lakh rupees, but it is 7.5 lakh rupees or even higher. And that's where there is this is the 11% is the volume CAGR. On top of that, there is a ASP growth. So which is where in nominal term, the sector growth is higher than the GDP. But as you see between 15 to 19, as the economy has slowed down, you've seen a deceleration in the growth rate for the sector as well. And as we got into the COVID period, you've seen that there was a substantial decline, and the reasons that we've just discussed, and which is where our expectation is that as we go back to the normalized curve, we will see a significant growth in the sector, and that's where the opportunity as far as investors are concerned. So can we move to the next slide? So this was one section trying in a few slides trying to tell the investors that there is an opportunity in the sector that is now moving towards the mean, which is the longer term growth trajectory, and which is where if you are investing today, you will get that opportunity. But now coming very specific to some of the sub segment, which is the passenger vehicle, like I spoke about in passenger vehicle, our penetration level is less than 3%. In some of the developed market, it is in fact upwards of 50%. In markets like China, it is close to 20 odd percent plus. So which is where as we go towards that $2,800 mark and per capita, we will see that effect as you move beyond those levels in per capita basis. Then you will see a substantial jump, and which is where the longer term opportunity. The other trend that we have observed is that premium people are moving towards a premium vehicle, which is no longer people are buying the basic version. It is no longer Alto LXI or lower end of the vehicle, but people today wanting to buy SUV looking vehicles. And that too, within that, what we have observed, the newer bookings are happening mostly towards the higher end of the variants, which are being offered by the manufacturers. So, and so just Sonal, can you go back? Yeah. What will drive the demand apart from income normalizing is that ease of financing, new product offering, and rising aspiration that we all know. We want to own a vehicle. Maybe it is difficult to own today, but what is facilitating people is also the ease of financing. And as manufacturers bring newer and newer product in the market, that will take people into the showrooms, and maybe of the 10, 3 or 4 will end up being the buyer in the of the product. So which is where you will see lots and lots of action from the manufacturer's perspective as well. And if the commodity prices, which is true not just for passenger vehicle, but for the entire sector, as the commodity prices go softer, which we have already seen, there is some good amount of reversal on the commodity side. You will see that the manufacturers are benefiting out of this. Yeah, let's move. Yeah. Similarly, on two-wheeler side, although here the penetration level is higher, maybe I'll say upwards of 40 odd percent as far as two-wheeler is concerned. But in some of the Southeast Asian market, we have seen clearly the penetration has a lot more room to grow, and especially the pocket of opportunity. So we all know there is a significant decline, like I have referred in one of my slides, that there has been a good amount of close to 36% decline in the volume from peak of FY19, which is what we can see. We peaked at around 21 million vehicle, and last year we did close to 14 odd million vehicle. But what we must realize is that there has been because these are on the lower side, the commodity inflation, regulatory changes, the cost impact on, or the cost of ownership of the consumer has been a lot higher, and people have been postponing purchase because of the same reason. But there is a good amount of, when we see on the numbers, there is a good amount of replacement demand, which will start to kick in as the economic activity goes back to normal. And this is a segment between 9 to 19 has grown at a double-digit CAGR. So that's where if we go back to the catch-up numbers again, there's a significant potential on growth side in this space as well. Some of the trends that we have observed in this space is that more and more people are moving towards the higher CC vehicle, and there is obviously people are especially on the urban areas, people are moving towards the scooter as a product, and again, obviously there will be a question in your mind, what's happening about the electrification in this segment. Yes, we have seen that the trend of electrification is higher as far as two-wheelers are concerned. So which is where in some of the cities we have seen the penetration as high as 8%. But we clearly believe it is because there are a number of players in this market. Based on the success, based on the feedback and the product readiness of the players are concerned, we believe that the incumbent should be in a better position to capture this opportunity, and which is where we're comfortable on this side. But yes, our view is that electrification will pick up first in the two-wheeler, and after that, over a period of time, it will move towards three-wheeler, buses, and finally it will go towards the passenger vehicle. Yeah. So can we move to the next? Now this is on the MNHCV. In the past slide as well, we have seen that this sector is basically more cyclical in nature and more driven by economic activity, and which is where we've seen sharp decline as the economic activity decelerated. We've seen sharp decline from 19 to 21. And there has been some pickup as well as the economy has started to normalize. There has been a good amount of pickup, but still, I must say that the sector is down 38% from the peak volume in FY19. From a longer term perspective, as you can see, this sector is a 6 to 7% volume growth industry. And a couple of factors like higher fleet utilization or a scrappage policy, which was announced 1.5 years back, and the pending replacement demand will drive the demand, and our expectation is that the volume should go back towards its longer term trajectory of 6-7% volume CAGR. Yeah. Auto ancillary, which is one of the other key component or space where we invest. Again, this space is basically benefiting from the volume opportunity, not just in the local market, but in they are actually gradually, as they have got more and more technology, as they have got more and more scale, they have become part of the value chain in the international OEM space as well. But the volume challenge that we have seen from the domestic OEM, it is not just true for India, but we have seen such challenges for the global players as well. And which is where this space is also, which was growing at a decent pace, has seen some sort of a consolidation to decline in last couple of years. But our expectation is that as we normalize, not just in India, but outside India as well on volume, because remember, globally, not just in India, but globally as well, there is a replacement demand, there is a pending demand, and at the same time, the companies are running with very low level of inventory. All of this should go towards as a scale opportunity for these companies. And there are multiple opportunities for these companies in terms of changing regulation, higher aspiration for people. So people are looking for more and more features in the car. So which will be an additional opportunity apart from just the volume growth for the space. And obviously this space has also seen multiple challenges on, because if your OEM is facing trouble in terms of margins, there has been some there has been some impact on these companies as well. But as the life normalizes, this companies will not just see the top line growth, but they should also see margin expansion. Finally, because we are this fund also invest in logistics, and again, like the numbers are suggesting in this slide, this sector has, especially for the organized players, it is expected to grow at a very high or a significant growth run rate. Underlying thought process behind this has been that in India, the cost of logistics is close to 13 to 14%. Versus internationally, this cost has been around 8%. So there has been a multiple drive or the government focus to bring this cost down from 13-14% to 8%, and which is where there have been sequence of investments as well as change in regulation, which should be helpful for the sector. And because there are newer age companies or well-prepared companies, we call them, let's call them organized players, or the well-prepared companies should be in position to capture this. Because when I talk about, let's say, the unorganized players, remember, trucking is the larger piece of this entire value chain. Still, more than 85% of the truck owners are owning truck less than 5, which is where you see a big opportunity, because people would wanting to be making them as the vendor partner, making it a more organized space. And remember, post GST, the drive towards this organized work has, or the organized logistics has actually just picked up, and which is where the opportunity for multiple players or the organized players in this space is. And remember, the e-commerce has made it more possible, and or maybe if I were to say, e-commerce is being assisted by even this sector. If your cost of sending a good is coming down from 100 rupees to 50 rupees, it opens up the trade opportunity for multiple players, and which is where it's a opportunity for both e-commerce companies as well as for these players in this space. Yeah, so just to summarize from this space perspective, overall, we've seen significant volume pressure as far as sector is concerned. But as economic activity normalizes, you will see volumes picking up. And not just volumes picking up, but the operating leverage will kick in as the commodity cost normalizes, or we've already seen some amount of softening in the commodity cost. You will see the profitability also improving for the space. And these are some of the numbers which I put in, but maybe we should keep one thing in mind, that this space, passenger vehicle is a 8% CAGR industry. Two-wheeler is 11% CAGR industry. Today we are running much below, or we have actually declined, and therefore the catch-up has to play as far as this sector is concerned. So yeah, with this I will just stop. And when we, as an investor, when we are investing in this space, remember, we are investing at the levels where the volumes are compressed, and from here on we should see a significant improvement in the profitability as well. Yeah, Sonal, over to you. Sonal? Sorry, you're not audible.
Yeah, hi Sachin. Thanks, Sachin, and thanks, Vetri, for sharing insights on the market economic indicators and the fund strategy. Uh, while we have a queue of questions lined up, and as we open the floor for further question and answers, I would request all the viewers to keep posting your questions and we will take them up. But before we take such questions, we have a couple of questions. The first question is to you, Sachin. While demand for cars has been strong, would there be continued supply disruptions due to geopolitical situations in Taiwan? What are your views on this?
No, sure, you're right. One of the factors behind the manufacturers struggling, or what you see deceleration in the volume or volumes not picked up, is despite good order booking, which has been reported by multiple manufacturers, that they are not able to meet demand, because one of the factor has been the semiconductor supply. Not just that, but there has been, because this space is so interlinked, that one disruption results in multiple challenges for the players. And which is where, if a situation like what you're describing, geopolitical situation like Taiwan, if it emerges, this will put some pressure on the manufacturers for sure. But they have all learned lesson, because this industry has worked, or at least before COVID, this industry was working on just-in-time kind of a concept, which is wherein back in 2000, or maybe in the COVID period, when they have seen that probably the demand will get compressed, they immediately cut the orders, and which is where post that they have seen the repercussions of that, because they have cut their orders on semiconductor, but the demand has not collapsed so much, but the semiconductor industry has actually diverted that to somewhere else. The key learning for the industry has been that they have actually now realized that some of the critical components, they have actually showed up their working capital, or they have showed up their inventory, and which is where they should be. If there is a temporary disruption or a short-term disruption, they should be better prepared. But yeah, if there is a longer term disruptions, then industry will have to figure out alternatives. But for sure, there are some learnings which the industry has had, and because we all know the semiconductor situation has been improving substantially. Maybe in some cases the demand for cell phones and the laptops and has been going down, so there will be good amount of easing out on the semiconductor situation. But industry has learned lesson. They should be able to meet it in short term. But yeah, if there are stretched longer term situations, then they will have to figure out the alternate solutions for that.
Thanks, that was quite useful. Moving on to the next question. That is again for you, Sachin. Auto OEMs are ramping up capacity to leverage on strong demand. While this may have an impact on profits of companies in the near term, would the companies be able to absorb the cost once the demand normalizes?
Oh, sure. So actually, multiple manufacturers that we learn are actually running short of capacities. And in fact, if they are all hoping or working towards actually improving the capacity as early as possible. So if they are able to ramp up the capacity in short period of time, they will definitely be making more profit. So there will be a capex angle to this, but actually most of them are working towards increasing capacity as early as possible, and therefore I do not see significant cost pressure or the profit pressure on them, because what they will sell. But the more important thing, Sonal, here is that remember, we are all talking about demand just going to the normalized curve of, let's say, high single digit or double digit growth. Eventually, the demand will pick up, and the base case for us should be that the demand will go towards this double digit kind of a growth, and in which case we need not worry about this cost which is resulting out of increased capacity, because at every point in time you will be running short of capacity once the demand normalizes, and therefore you will keep adding capacity. So priority today for many manufacturers with healthy order book is to just ramp up capacity to meet the customer's demand, and not let them go without what potentially they want.
Thanks for the answer, Sachin. Moving on to the next question. I hope Vetri, maybe you can take this question. This is Indian IT services industry created over 5 lakhs new jobs in FY22 amidst unprecedented attrition. Is this industry heading for a paradigm shift with metaverse, Web3 and Industry 4.0 looming on the horizon? Over to you, Vetri.
Yeah, sure. Well, interesting question. Remember that the IT industry has been one of the industries which has created the maximum number of organized sector jobs going back almost 2 decades. So I would say this is nothing unusual. And because the industry has been growing every year, it adds, more staff compared to what it did in the previous year. Because this is a very, people-intensive industry, and particularly the IT services that Indian companies provide typically tend to be very IT-intensive. Is the industry heading for a paradigm shift with Metaverse, Web3, Industry 4.0? I think the history of the IT sector is that there are periods where the cycle grows faster, there are periods where the cycle grows slower. It does seem like they're entering a period where the cycle grows slightly faster. But we also have to be careful in terms of interpretation, because, what happens is that when you look at overall IT spends globally, this grows only at the same, 2%, 2.5%, 3% kind of range over a period of time. Now, within that, the spending may keep shifting from one area to another. So, for example, once upon a time, companies focused a lot on building their own IT infrastructure, starting from hardware to proprietary software, so on and so forth. Then we went to an era where increasingly companies said, let's start running our infrastructure with outside support. Then they said, let's move to standardized enterprise software and databases, be it Oracle's, be it SAP, so on and so forth. And then they finally moved to software services being designed specifically for them, to using software as a service from third-party providers. So within that overall pie of spending may shift very dramatically from one subsegment to another subsegment. But the overall pie itself grows at that same 2 to 3% per annum. So therefore, I would say that yes, companies which are well positioned to benefit in terms of having the skill set and the ability to meet the demand for services targeting some of these areas which you have mentioned may be able to grow slightly faster. But the aggregate pool of IT spending is unlikely to grow significantly faster than what it has grown in the past, because the spending keeps shifting from one place to another. So if companies move to spending more on cloud and more on SaaS, automatically they reduce their spending on some of the things where they used to spend historically. So we need to be careful when we interpret this. The industry has been on a growth runway for, pretty much my entire career. This has always been an industry with consistent and steady growth. I think it will remain that way. But just because you hear 3 new fancy terms, don't presume that suddenly growth will accelerate, because companies will reduce their spending elsewhere and move the budget over there. So that's the lesson from history, and don't lose sight of that.
That was quite an insightful answer, Vetri. Thank you so much for this. Moving on to the questions from our viewers that we have received, I will now stop sharing the presentation. Yeah, so this question is over to Vetri. After 2 quarters of market correction, we have seen some recovery over the last month, supported positive FBI inflows. To what extent have macro variables, including inflation, higher interest rates, higher oil prices, and lower global liquidity, have been factored in the current market valuations?
That's a very intelligent question. You have put a lot of variables in that question. I must admit that I don't lose too much sleep thinking about these variables. And, I keep referring back to UTI's investment process, which is UTI's core alpha. It's all about identifying the businesses that can create value and then constructing them using certain guardrails, which are part of UTI's core alpha. In none of that do we get involved in trying to understand where will foreign flows come, when will they come, how will they come. Where the market will go in the next 3 months and 6 months is not part of our investment process. So my very honest answer to you, I don't know how these variables will behave. Sometimes they will behave positively, sometimes they will behave negatively. But my big picture approach is that valuations fluctuate. When valuations are very, very cheap, as investors, one should raise asset allocation. When valuations are expensive, one should reduce valuation, one should reduce exposure. Simply because it's a risk management framework. You will never know where each of these variables can go. If you had told anybody 5 years ago that in 5 years' time, Indian investors will put 12,000 crores a month into Indian equities by way of SIPs, they would not only have laughed at you, they may have suggested that you should be taken to a doctor for a psychiatric evaluation, because this was not the baseline forecast that anybody had. So we honestly don't waste any of our time thinking about these issues. I'm not saying none of those points that you made are relevant to the market's behavior, just that it is impossible to forecast these, where geopolitical tension will come from. Who knew there was a thing called a pandemic till 2020? Who knew that the Fed would hike rates so aggressively? Remember, I told you in October 21, people said the Fed itself forecasted that there will be no rate hikes till 2023, and you've got 225 basis points of rate hike. So these things will keep happening. It's good to know them, but I would strongly recommend don't allow your investment process. We certainly don't let our investment process be driven by these variables, because I'm very honest, I don't know how to forecast these variables.
Thanks for this. Next question is for you, Sachin. With the rise in shared mobility, it is likely to save on costs and convenience are frequently cited as popular reasons for shifting to a shared mode. Could this be in any way a headwind for revenue expansion for OEMs? You are on mute, Sachin.
So it's a good point, and that was the case. Actually, it is very convenient for all of us to actually just go book a cab and actually a ride hail. But actually, maybe before 2019 or maybe before pandemic, actually, one thing which was already happening in this industry is that there are two perspectives. One perspective is of the cab aggregator or the offering. And second was from the consumer's perspective. So from cab aggregator's perspective, there was a lot of PE funding which was coming in, and the same money was actually used, one, to incentivize people to be part of this platform. That's the drivers. So they were earning good take-home salary even after paying for their vehicles or the EMI of their vehicles. But at the same time, these companies were in a position to offer good amount of incentives for people to get onto this platform. So there were two good things happening, obviously at the cost of this PE money, right? So all of us were happy to be part of this journey, and it was very convenient. But gradually, this PE money has stopped coming, or there is some amount of consolidation resulted. The driver's take home has actually substantially gone down. As a result of which, many of them are actually gradually getting out of the value chain, and which is where, as a consumer, when today you try to book a cab, earlier it was available at easily, today it is not so much easily available for you. At the same time, from the consumer's perspective, earlier they were offering you discounts. Today there are surge charges, and which is where, from customer's perspective or from my perspective, one, I do not have visibility whether I'll get the vehicle or not, and second, I have to pay more. both these factors are actually taking the dynamics completely, or maybe earlier, if we were just one-minded that yes, this is the way to go, today we are rethinking about it, and which is where there has been some good amount of the shift towards the personal vehicle. Plus, after COVID, people have realized that at least you need to have your one vehicle of your own as a mobility service, as for the mobility, and which is where I think maybe 3 years back when the pendulum was just swinging in one side, now today it's more towards actually somewhere in between. So that's what I will say, that both this platform will exist, but not in the way we used to think 3 years back. And there should be a good demand for the personal mobility as well.
Yeah, just to add to what Sachin said, I don't know how many of you are aware, but at least I, for one, remember that the first time I used an Uber was in 2013 in India. So 9 years of Uber in India. And I think, if I'm not mistaken, Uber is now about 14 years old. So maybe they offered their first ride in 2009 in the US. The fact of the matter is that that business model has still not managed to create any positive cash flow for itself. Right. So Sachin was mentioning the lack of PE capital. Now, if the entire business model is based on subsidy by capital providers and it is unable to generate any cash flow on its own, then I would submit that that business model is unlikely to, completely disturb the equilibrium. Certainly, when capital was abundantly available, it looked like it could disturb it. And, I'm sure all of us will admit that we've all been, thankful for the existence of that service. But if the service is not able to generate money, then I think increasingly we have to be a lot more cautious about the ability of this service to become a global phenomenon. And if the only way to become profitable for it is to take the price up, then maybe the balance in terms of should I have my own vehicle vis-a-vis should I use ride hailing starts to look very different as compared to the comparisons we were making 3 years ago.
Yeah. Thanks, Sachin and Vetri, for the answer. On a follow-up question to you, Sachin, used car market is growing at 14+%. Does that not compensate the gap in demand, and how can we tap the growth of used vehicles? This is a question by Diktanu Chaudhary.
No, so certainly used car is a very big market globally. And India we are just around 1.5 times of the new vehicles sold. But there is a potential for that market to be maybe at least 2x of what it is today. But remember, Sonal, the initial variables that I have shared with you, which is the penetration level, which is not even 3% from our perspective, and this variable is very strong, and which is where the longer term potential will be. So. And globally, again, the other variable that we need to keep in mind is that globally, the emission standards are becoming more and more stringent. And that's the other driver from the market's perspective, is that today we have a scrappage policy. It has been made less stringent as an introductory part of it. But gradually you will find that these emission norms, and therefore today it is 20 years. At some point, I don't know whether we realize or not, but the registration life for a vehicle is 15 years. Post that, you have to keep registering every 5 years. And the cost of that has been continuously going up. And you will find that chain to be more and more stringent. So both will happen. The replacement market will also expand, but at the same time, you will find the newer market will also expand. And remember, the other variable is that the new car buyer itself is forming close to 30 to 35% of the overall market, which is the one leg of the growth. The other leg of the growth is the replacement itself got postponed. When we look at the number, we clearly realize, be it the four-wheeler or even the two-wheeler, which is not the point of discussion. In both cases, we have seen that the replacement has been, there has been potential demand that we can clearly see, because people have been postponing this decision to buy new vehicle for last 1.5, 2 years. So that should also start to kick in.
Yeah, thanks for this, Sachin. We have two more questions and they're addressed to you, Vetri. So this question is from Mr. Ganesh Lohakre. He is asking what will be the futures of startups as the banks are not interested in giving them finance, and also they have started retrenching people, and also seeing the cases of Paytm and Zomato. So would you like to share some views on this?
Sure. So I would just say that startups primarily depend on venture capital. They primarily depend on equity capital, either coming from, in the very early stages from venture capital funds, and maybe at a later stage from public markets. Actually, none of the startups, to the best of my knowledge, have significant borrowings from banks, because typically they don't have business models where they can really leverage capital from the banks. And, they are at a stage in their growth cycle where any case lenders would be slightly cautious about, extending significant credit to these companies when they are in their initial stages, actually having to burn through some capital. So I don't think in any sense the life cycle or growth cycle of startups is related to the availability of bank funding, but certainly they will be impacted by the availability of venture capital funding. And some of you may have read, about SoftBank, one of the world's largest venture capital funds. They made an announcement, I think 3 days ago, whereby they said that there is effectively a 95 or 99% drop in the new investments that they made in the last quarter as compared to the previous year. And that's reflective of the fact that venture capital funding itself has become very, very limited at this point of time. But we must understand this, because venture capital funding also goes through its own cycles. There is no doubt about that. Those who have already got funding and have not burnt through that capital actually may be in a reasonably good situation now, presuming the rest of the elements of their business model are in place, because now they have the ability to, build a business more intelligently, rather than worry about who else may come and suddenly throw money into the equation in an attempt to use cheap capital and build a business overnight. So well-funded incumbents, certainly in a slightly more advantageous position, presuming that they understand how to use the capital that they already have on their balance sheet more intelligently, and don't run their business in a way that they would require further inflows from VC funds in the near future. So I would continue to believe that India remains one of the most attractive markets for the entire startup and ecosystem. And I think you will see that in the FDI numbers. Maybe this year will be a quiet year. But, again, as I said, these things are cyclical, and at some point you will start to see the fund flow pick up again. And in fact, when I talk to many people I know on the PE side of the business, some of them actually say that we were very quiet in the last 2 years, but we've raised all our money and now we will gradually start deployment. So I would not worry too much. If anything, it will make the whole sector a lot more disciplined.
Yeah, thanks for this, Vetri. This is the last question for the day. It is by Mr. Anil Kumar. He is asking, the rupee has depreciated versus the dollar and had touched an all-time low this calendar year, and sentiment remains weak for the rupee amid quantitative tightening by Fed Reserve. If persistent inflation is here to stay, could it dampen the forex reserves comfort that we have at present today?
Sure. So let me answer that in two different ways. Of course, the rupee has fallen, but tell me which currency has not fallen against the dollar this year, right? Because when you go from a US, which is unlikely to raise interest rates in 2022, that was the belief 1 year ago, to 225 basis points of hike and maybe another 75 basis points hike next year, then obviously the dollar becomes extremely strong. Almost everything struggles then in the face of the dollar. When you look at it in that context, while the rupee is down this year, it is actually among the better performing currencies vis-a-vis the dollar. So I think please keep that in mind when you look at the dollar, when you look at the rupee's fall vis-a-vis the dollar. We have actually done much better than many of the other countries and currencies, and that's the reflection of the slightly better credentials that we have. You also mentioned inflation. I would actually submit that the rupee's long-term trajectory vis-a-vis the dollar reflects that it tends to depreciate at the rate of 3 to 4% per annum. It doesn't come like clockwork. Some years it may fall 10%, some years it has even appreciated, but over time it has depreciated at 3 to 4% a year. That is a function of the inflation differential between the US and India. currently the inflation differential is actually in favor of India, but maybe there is some base effects, maybe there is some normalization which has to take place. But I think eventually it looks like this differential may actually settle down at a much smaller number than what it was in the past. So it is potentially possible if India is able to deliver its 4% inflation target and the US actually stumbles relative to its 2% inflation target, maybe 2 to 3% inflation, then it's possible that the rupee's depreciation actually becomes a lot more subdued vis-a-vis the dollar going forward. But depreciation is a reflection of inflation differentials at a very simple theoretical textbook level, and therefore, 3 to 4% depreciation a year, as per history, is not surprising. What may surprise us is that in the next 10 years, it may be at a much lower level if that inflation differential were to come down.
Thanks for such a detailed answer, Vetri. We have no further questions lined up. Maybe you can share some closing remarks.
Sure. Thank you very much, Sonal. I know it's been your first time, hosting this event from the product team, but you've done a flawless job. So thank you for that. And thanks, Sachin, for the very detailed rundown of the Transportation and Logistics Fund strategy. I hope today's session was useful, both in terms of providing some context on where the economy is, specifically from the questions that you all sent us, and also in terms of where the market is in terms of valuations, and a quick wrap up. Thank you for your participation today. Have a good evening, and we look forward to your participation and questions in this event, which will once again be sometime in the in the second week of September. Thank you and goodbye.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.